markets have had a really very strong quarter. We've seen very significant gains from equity markets over the 3 months to December. Through the first half of the quarter, not a lot was happening, but post-Trump's election, we saw markets, after initially being sort of somewhat nervous about what that meant, very quickly turning around and moving markets higher. And that was really on the back of a view that we were likely to see some, quite aggressive fiscal stimulus through 2017 and 18. That includes tax cuts, less regulation, infrastructure spending, and that ultimately will be very good for corporate profits and ultimately very good for equities. Australian equities actually also had a very good quarter, driven by a similar theme, but this was all about higher commodity prices, and we saw the Australian market one of the best performing markets over the period. There were losers out of all of this, and that was really the bond market. So we did see a very sharp jump in bond yields, both here in Australia, but also globally as well. And so we did see some negative returns from bond markets, which is the first time for quite some time. So the balanced growth options had a pretty good quarter actually, performed in line with the market and in line with peers, benefiting somewhat from their underweight to yield instruments. For example, the balanced growth diversified option hasn't actually held anything in international bonds, and given the sell-off over the quarter, that was very beneficial. Over the course of the year, though, we have seen some underperformance relative to our peers and competitors. The primary reason for that is underperformance within the Australian equity component of the portfolio. We did see a huge divergence in Australian equities over the year, resource sector doing around 40%, but the industrial sector only doing around 2%. And that story really hurts our managers in that sector. We saw them underweight resources initially when commodity prices started to rally. And that underweight, as you can see with the very significant divergence in performance, really did hurt over the course of the year and cause some underperformance. We're hopeful that we'll see some of that unwound over the course of the next few months. So I think the outlook for 2017 is actually quite supportive in the short term. We are seeing some, really strong signs of genuine growth, and that's not just coming from the US, that's also coming from other regions such as Europe and also Asia and even Japan, and that's going to be very positive for earnings. On top of that, add some fiscal stimulus, which we're obviously expecting as part of Trump's policies, tax cuts, infrastructure spending, less regulation. All of those things should be very positive for company earnings over the course of at least the next 6 months. Obviously, there's some things to worry about as well, and we are concerned about what will happen in terms of trade policies, somewhat of an unknown at this point in time. We have seen higher bond yields, and ultimately higher bond yields will be negative for equities, but we think that story is probably some way away. In addition, we're also seeing some increased inflation expectations. Now, inflation expectations rising is actually a good thing because, if you recall, a year ago we were worried about deflation. Again, I don't think that's going to be an issue this year, but just definitely something to watch. And finally, we have a whole range of European elections over the course of 2017 that we have some rise in terms of the views around leaving the European Union, and that may cause the market some nerves. So that makes us a little bit cautious. Generally, we're pretty neutrally positioned to equities despite the run-up that we've had to date. More recently, we've put a little bit of options protection into the portfolio just to protect us if we were to see a sizable fall, given some of those risks that I mentioned before.